Dividend aristocrats have some very impressive streaks for raising their dividends every year. Today, we will be looking at 8 of the best of those dividend stackers. Hold on to your seats. This is going to be a good one. Dividend aristocrats is a term used to refer to companies that have consistently increased their dividends year after year for at least 5 years in Canada. We currently have 95 companies on the Dividend Aristocrat list. This list is updated often as aristocrats, well, they do tend to rise and fall. For many companies, being on this list is a very nice badge of honor. So the higher their streak, the harder they work to keep it alive. Now, for those who hit the magic number of 50 consecutive years, they become what we call a dividend king. Canada only has one dividend king so far. I have a feeling they may very well be on this list. Join the conversation. Let us know in the comments your favorite dividend aristocrat. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and thank you for that click. We have those 8 dividend aristocrats in the wings, just waiting for us to talk about them. So we are going to jump right on in and get our snoot on for all those aristocrats. Kicking off our list, we have Canadian Utilities Ltd with a ticker of CU. They are based out of Calgary, and they are actually part of the Exco Group. They are involved heavily with power generation as well as utilities. They have a market cap of $9.51 billion, and we do not have a beta for this one. They're the only ones on the list without a beta. Their EPS comes in at 2.20, and they have a PE ratio of 15.97. Their return on equity comes in at 9.20%, and their debt to equity ratio comes in at 135.73, a little higher than I like, but not out of place for this company at all. Now, let's jump into their yield. Their yield comes in at 5.13%. That's paid out quarterly in the amount of 44.9 cents per share. Now, these dividends, they've increased them for 50 years in a row. So this here is our only dividend king. Although Fortis is not too far off. They're not on today's list, but they'll be our next dividend king within a couple of years. They have a payout ratio of 80.93%. When we look at their returns, their 3-year ROI comes in at 20.38%. We add in those dividends and we get a total return of 25.68%. That is pretty darn good for a 3-year. In 2022, their ROI comes in at 1.16% for a total return of 6.29% once we factor in some dividends. That is fantastic considering we're looking at a bear market. Yes, we did have a little bit of a energy boom in 2022, so that certainly helped them big time. In 2023, their return on investment is a little bit off the mark. It's at negative 4.15%. This is a company that I have full faith in. Some of their numbers are maybe not where I would like them to be, but they're very blue chip. They've been around for a long time, and they have passed through many recessions without too much concern. Coming in at number 7, we have Emera Incorporated with a ticker of EMA. They are based out of Halifax, Nova Scotia, and they are a multinational energy holding company. Their market cap comes in at $14.61 billion, and they have an insanely stable beta of 0.27. Their EPS comes in at 3.51, and they have a price to earnings ratio of 15.33. Their return on equity comes in at 9.35%, and they have a debt to equity ratio, once again, it's going to be high, 167.0. All right, let's move into their dividends. Their current yield is 5.18%. That's paid out quarterly in the amount of 69 cents per share. They have increased that dividend for 15 years in a row, and their payout ratio is 75.42%. That's not too bad. Their 3-year ROI came in at 12.12%, and adding in those dividends, we get a total return of 17.30%. Now, when we do look at 2022, their return on investment came in at negative 17.84%. Adding in the dividends, we get a total return of negative 12.66%. This drop, though it looks bad, it's actually in line with the market. Even though it's never fun to see those negative returns, it's not as bad as it looks. In 2023, their ROI has increased 3.30%. And I'm going to add right now, for these companies in 2023, I have not factored in any dividends yet because some of them have received them, some of them haven't because a lot of them are on quarterly dividends. So keep in mind there are still dividends to factor into that ROI number for 2023. All right, let's move on to number 6, and we have Telus Corporation with a ticker of T. They are based out of Vancouver, and they are one of Canada's big three telecommunication companies. Their market cap comes in at $39.27 billion. They've got a pretty stable beta of 0.64. Their earnings per share comes in at 1.15, and their PE ratio is at 23.75. They have a return of equity of 10.19%, and their debt to equity ratio comes in at 142.59%. All right, let's jump over to their yield. They've got a yield of 5.2%. That is paid out quarterly in the amount of 35.1 cents per share. Now, those dividends, they have increased them for 18 years in a row. Their payout ratio a little bit high, 117.89%. Normally, I would say once you cross that 100% on a payout ratio, the dividend is not sustainable, but where we're dealing with aristocrats, they will make it sustainable. All right, their 3-year return on investment comes in at a nice 43.74% for a total return of 48.94%. In 2022, their ROI did drop like the market down to negative 12.37%, total return of negative 7.17%. That still outperforms the overall market, so you gotta give them a pass on that one. In 2023, their ROI came in at 3.84%. Once again, Telus, blue chip, not a company that I'm concerned with at all. And as you guys know, I did a recent deep dive on them, and their outlook is not too shabby. Coming in at number 5, we have Manulife Financial with a ticker of MFC. They are based out of Toronto, and they are one of Canada's biggest insurance companies. Their market cap comes in at $50.88 billion, and they've got a fairly average beta of 1.13. Their earnings per share comes in at 3.70, and their PE ratio comes in at 7.40. Their return on equity, well, that comes in at 12.46%, and this one I love, their debt to equity ratio is a measly 43.99. All right, let's switch over to their yield. That comes in at 5.37%. It's paid out quarterly in the amount of 36.5 cents per share, and I will say they just recently raised that dividend, and in fact, they've increased their dividend for 8 years in a row. Their payout ratio is nice and low at 35.87%. This is a company I absolutely love. Wait till you see the returns. Their 3-year return on investment comes in at 73.29%. Factor in those dividends, and we get a holy banana bread level 78.66%. That is awesome. In 2022, they did falter a tiny bit, and they had an ROI of negative 2.38%, but you factor in the dividends, and it pushes it up to 2.99%. They absolutely crushed the market with those numbers. Now, in 2023, this is fantastic. Their return on investment this year is up to an amazing 12.44%. Manulife Financial is just absolutely dominating their market right now. They have expansions into China. Their earnings have been fantastic. This is a company to definitely watch. All right, let's move on to number 4, because at number 4, we've got the Canadian Imperial Bank of Commerce with a ticker of CM. They are based out of Toronto, and they are one of Canada's big 6 banks. Their market cap comes in at $57.51 billion. They've got an average beta of 1.05. Their EPS comes in at 5.02, and they have a price to earnings ratio of 12.57. Their return on equity comes in at 9.89%. Their debt to equity ratio, they do not provide it. They have not provided it. There's some missing data, so we can't get that reading, but I did look, and they do have $196.1 billion in debt. That seems like a lot, but right now banks are holding a lot of debt, and that's kind of part of what they do, so I wouldn't be super concerned about their debt at this stage. Now, if we move over to their yield, it comes in at 5.45%, and that's paid out quarterly in the amount of 85 cents per share. They've increased that dividend for 11 straight years. Their payout ratio is 65.51%, which is not too bad. Now, when we look at their ROI, their 3-year ROI is also really nice. It's 70.49%. Add in those dividends, and we get a total return of 75.94%. However, in 2022, when the financial system in Canada really suffered, their ROI reflects that at negative 26.62%. Adding in the dividends, it only brings it up to negative 21.17%. They underperformed the market, so that's always concerning, but the entire financial system, all of the banks really struggled, so you kind of have to sort of say, how did they do compared to these other banks, and not so much comparing them to the market in this situation, and they're pretty much in line, some worse, some better. All right, but what about 2023? 2023 2023, their return on investment so far this year is 14.19%. So they seem to be doing really well in their recovery, and that bodes well for CIBC for sure. Okay, so taking our third spot, we have Exco Technologies with a ticker of XTC. They are based out of Markham, Ontario, and then they are a big designer, developer, and manufacturer of things like dies, molds, component assemblies, and consumable equipment. Their market cap, and they're the lowest one on the list today, comes in at $308.19 million. They've got a pretty stable beta of 0.57. Their earnings per share comes in at 5.02, and their price to earnings ratio comes in at 13.89. Their return on equity comes in at 5.95%, and once again, another debt to equity ratio that I love, 32.95. When we move over to their yield comes in at 5.57%, paid out quarterly in the amount of 10.5 cents per share. They have increased that dividend for 16 years in a row, and their payout ratio comes in at 77.78%. All right, let's take a look and see how they've done though. Their 3-year ROI comes in at 36.32%, factoring in dividends, we get 42.27%. 2022, they did struggle. Their ROI was negative 25.75%, and adding in those dividends, we get a total return of negative 20.18%. That underperformed the market, and that is definitely concerning, but at least in 2023, their ROI is in the positive at 2.86%. So hopefully they will do a lot better as the market begins to recover. That's what we're hoping for these guys. In our almost top spot, we have Energy Corporation with a ticker of TRP. They are based out of Calgary, and they are all about their pipelines and also power generation all across North America. They've got a pretty hefty market cap of $56.18 billion and a beta that's on the stable side at 0.86. Their EPS comes in at 0.66, and their PE ratio comes in at 85.12. Their return on equity comes in at 2.33%, and their debt to equity ratio a little bit high at 172.38. Okay, let's move to their yield. Their yield comes in at 6.77%, and that's paid out quarterly in the amount of 93 cents per share. They have increased their dividend for 21 years in a row. However, they have a really high payout ratio of 562.50%. That concerns me. I feel like this company should be doing a little bit better. But let's take a look and see how their returns look. Their 3-year ROI comes in at 11.47% for a total return of 18.24%. In 2022, their ROI came in at negative 9.60%. Factor in those dividends, we get a total return of negative 2.83%. So they did overperform the market. That's perfect. 2023, so far, their ROI is coming in at 3.56%. A few of their fundamentals are definitely concerning, but I do think once the market turns around, some of those numbers will come back down to earth. All right, let's move to our top spot. In our top spot, we have Enbridge with a ticker of ENB. They are based out of Calgary, and they're all about their pipelines, renewables, and utilities. Their market cap comes in at $106.97 billion, and their beta comes in at 0.89. Their EPS comes in at 1.31, and they've got a PE ratio of 40.33. Their return on equity comes in at 4.64%, and their debt to equity ratio comes in at 129.03. Moving to their yield, they've got a yield of 6.87%. That's paid out quarterly in the amount of 88.7 cents per share. They have increased their dividend payouts for 26 years in a row, so that's not too shabby. Their payout ratio, though, a little high, 268.75%. Their 3-year ROI comes in at 46.75%, and they have a total return after we factor in those dividends of 53.62%. Before we get to 22, I will mention I did a deep dive on these guys recently, and if you look at the 3-year ROI then, it was not quite so rosy, and part of the reason is we've now moved past the pandemic bump. A lot of our 3 years are going to start looking a lot better because we're not going to have that giant drop. That's just one of those things to keep in mind as we move forward. When you start seeing better 3 years, it's all because we've moved past the bump. All right, in 2022, their ROI came in at 4.94%. Add in those dividends and we get a total return of 11.76%. Not bad. Now, so far in 2023, their ROI is slightly negative at negative 0.68%. Enbridge is absolutely a company we know long-term is going to do very well, and they definitely are a company with some really good long-term prospects. These are the higher payers when it comes to to Dividend Aristocrats, and as you can see, there are a few potential total return plays in this list. A good many of them are blue chip, and they have some pretty great overall long-term investment potential. The higher the streak of consecutive dividend raises, the more likely the company will ensure that they keep raising that dividend, even in the cases where they really should lower it and concentrate on their debt. However, as much as it looks in some cases that their debt's getting out of control, these are companies with deeper pockets, and the situation will look very different once we are about a year into the bull market. Keep the learning going, watch my video on my portfolio peak linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner. See you in the next video.